Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Okay, Simon, this week, let's talk about, is it better to invest in one more expensive property or two average properties? I get this question quite a bit because some people think that obviously their capacity from a lending perspective or a deposit perspective is cheaper property is better. But I want to explore that with you tonight because, at the end of the day, it comes down to, there's no right or wrong. It comes down to the individual client strategy. So really investing in property is trying to determine what are we doing it for? What are the goals and objectives? What's the strategy behind it? And then we're in a position to understand what's your capacity, of course, as well as your appetite. And then we're in a position to work out, well, is it right to invest in a more expensive property or to average properties? And the long and the short of it is there's an argument for both sides. So the benefits of one, more expensive good property, can often suit certain people, whereas possibly taking a more slower approach to two average properties over a longer period of time is more within people's comfort zones or capacity from a multitude of reasons. So we're going to explore those tonight. Obviously, lending being a big part of that. So be interested to hear your comments in relation to that. But essentially, really, the arguments for two average properties, gives more flexibility. It gives you diversification. So you're spreading your investments across a couple of properties, which might be geographical diversification. So, if, as we know, property moves in cycles. So if one particular property is on an upswing in terms of growth and the other one's possibly going through a bit of stagnation, it's always best to have something moving forward. So you're spreading that by the diversification side of it. Excuse me. There's also the fact of, if one of those properties has a short-term vacancy, then at least you've also got another property that's tenanted, got cash flow coming in. So you're spreading your risk a little bit. Yeah, very true. Risk, Simon, is something that a lot of people don't consider when they go on their investment journey. But, even from a lending perspective, there's risk associated with investing in properties. So give me some thoughts on how you can possibly reduce your risk when it comes to financing some of these properties.
Yeah, I suppose I was going to go into it in a bit more detail later on, but getting your loan structure right to match your strategy is quite important. And you mentioned in there that if one property has gone up in value and another property has either flatlined or gone down, and being able to then utilize that increase in equity. Now, if your loan structure is incorrect, namely cross-securitized, then that could be a real issue. Whereas if you had them with separate lenders, for example, then you could look at just increasing the loan on the one which the equity's gone up and then move forward to that whatever opportunity that you're looking at there, sort of thing. So it's one way of just being able to continue to access finance when able to keep investing, with your and keep going on with your strategy.
Yeah, absolutely. And the other thing in the lending world is if you've got one more expensive property, then you've got to come up with a larger deposit to get into that property. Whereas if you take a little bit more of a stepped approach, you might only have to come up with a smaller deposit to get into the first property, allow that first property time in the market to go up in value, and then we can recycle the equity from the growth of that first property, so you don't have to save or draw equity out of your own home to get into the second property.
Yeah, and I suppose there's another point there is like if you're borrowing at above 80% and you need mortgage insurance, the mortgage insurance is exponential. So the higher the loan amount is and the LVR, the more it's going to be. So if you're looking at comparing just the one property versus a lower price property, your LMI, your mortgage insurance fee is going to be a lot more on that more expensive property because that loan amount is going to be more as well. So.
Yeah, absolutely. One of the other arguments for having, I guess, two average price properties is when you look at rental income. What's interesting about, let's say, a more expensive investment property. Now, for context, let's talk just some rough prices. Just obviously, it's going to differ as to what market we're investing in or what style of property we're investing in. But let's take, for example, for the sake of the conversation, let's use a house as a more expensive property might be $1.5 million. And if we're looking at two average properties, it might be two houses at $750,000 each. The house that's at $1.5 million, typically what I've found in most areas, when you start to get higher than that $1.2, $1.3 million mark, the rental yield as a percentage of the property's value drops away. So when we get to 1.5, and again, I'll talk broadly here because we're not talking specific locations, but typically, let's say a $1.5 million property probably rents for in and around $1,200 to $1,000, call it $300 per week, if we're in the right area, in the right market. Versus a $750,000 property might rent at $700 a week. So proportionately, the rental yield as a percentage is higher on the average price property because it becomes a matter of being more affordable. Obviously, the rental market starts to reduce when you get over that $1,200, up over $1,000 a week even, because that's not what most people can afford. So it's an interesting one to think about, because obviously for some people, as you know, that rental yield is important from a finance perspective as well.
Yeah, I was just going to mention that with serviceability. Like, it's not going to be move the needle dramatically, but it will have that impact, especially when you just need it to get across the line, where that yield's just going to push you over the needle, I suppose is what I'm trying to say.
Yeah, so there's positives within that. Obviously, again, like I said earlier, if you've got two properties, there's greater potential for equity building because, property moves in cycles, like I said. So one property might be going up for the next couple of years. Then beyond that, the next property might be going up for a couple of years. Whereas if you have effectively all your eggs in one basket, you may get that 2-year growth window, but then you might go through a flat period for the next 2 to 3 years.
Yeah.
So it's about your portfolio building up, not just, having all your eggs in one basket. And then, the other thing that we need to consider is within having an individual property, if you do have that vacancy or there is repairs required, or anything that may be an impact to a stable income stream, then, that could give you some difficulties over the short term, as opposed to, again, and they're exacerbated when you're talking $1,200 a week, hypothetically, in rent. If you have a 3-week vacancy, that's going to impact on your ability to pay that mortgage repayment for that month.
Yeah.
As opposed to potentially a 3-week vacancy on a property that's renting at just over half of that. So all these things are certainly worthwhile considering within the strategy. the potential tax benefits. We're obviously not going to go into the realm of giving tax advice here, but certainly owning multiple properties allows you to spread your expenses and potentially take advantage of some depreciation deductions. But also, as we know, Simon, the little known tax that not a lot of people talk about is land tax.
Yeah. It creeps up on people when they get that letter in the post.
So for those of you who don't know what land tax is, if you've got multiple properties in a state or you exceed a certain value, and it varies by state, but if you hold a certain value in land in a individual state, then you start to incur land tax. So again, probably another benefit for having geographical diversification, because you can avoid things like land tax because it's a state-specific tax. So, but certainly for those that are focused on the tax benefits with their investing, as we should all be aware of them, these are some of the considerations. In terms of, I guess, multiple properties, the thing to be aware of is we're in 2025 now, and if I talk $750,000 properties, unfortunately, if we're talking more sort of chasing capital growth closer to capital cities, $750,000 as a budget now has become exceptionally tough with a lot of properties. Pretty much for most of the larger capital cities in Australia, if we're trying to invest within, let's say, a 30-kilometre radius of the CBD, typically houses now are pretty much almost out of the equation when we're talking a $750,000 property. So if we want to stay within that sort of budget, we're probably got to be more open to units and townhouses. Again, this comes back to strategy. Units and townhouses may not give you that growth that you're chasing. So it's a case of possibly adjusting things, moving it up a little bit. Maybe it's not a $1.5 million property, but maybe there's a market where we can get something in and around 900 to $1 million to stay within that house and land type investment that's still going to give us some solid capital growth. And then we just probably need to be a bit patient from building in terms of building a portfolio to be able to enter into that second property. But it's a real balancing act. I mean, Simon, you and I have been in the game long enough to remember where we could pretty much take a fairly good run at most capital cities for $750,000.
Yeah.
But unfortunately, those days are gone.
Yeah, long gone. Yeah, and I was just going to say, there's no point in pushing a round peg in a square hole, as well, to force to have two properties. Like, if there's only one good solid property available in your budget, and that's going to match your strategy, then there's no point, trying to force two, and lowering the budget or something like that,
Yeah, 100%. And I guess that's where I'm going, in this next part is there's an argument for one good property. And I quite often talk to particularly clients that have got a bit more capacity, particularly clients that are wanting some stronger results. There's certainly an argument for one good property. So let me kick off and say, well, if your $750,000 property, let's say, averages 7% growth per annum over the next 10 years, and you invest in the next suburb over in a $1.5 million property that averages the same growth percentage, 7% over the same period, 10 years, you're always going to, of course, get the stronger compounding growth result out of a 7% of $1.5 million is obviously significantly higher than 7% of $750,000. And that compounds over the 10 years. So from a capital growth perspective, certainly that is a big draw card to being able to go into that better quality of property. And then you can certainly look at it from a simplicity perspective. You've got less property in your portfolio to manage. You don't have to deal with, multiples of property managers or multiples of tenants or, any other issues that might come up, whether it's maintenance or vacancies. You just got to work within that one property, or, if the ideal is to get two really good properties over a period of time. So it's about returns. It's about simplicity. Perhaps, you can put more focus into that property and delivering the right results, but you also have the ability, possibly over a shorter period of time, to leverage that. So, Simon, if we're talking 7% growth over as an average over the next couple of years, your ability should be to draw a higher growth and therefore be able to pull out equity sooner to get into, if you've got capacity, to get into another property.
Yeah, because I suppose my side of things is obviously you first up at that end of the spectrum, your loan to value ratio, your LVR is going to drop. So you should be able to get better deals, home loan deals, and your assessment rate will drop slightly. So that will improve your serviceability. Again, we're not talking a huge amount, but everything, all these little increments helps along the way, sort of thing. And I suppose the most critical one is probably the rental yield is going to, or the rental return is going to increase quite a bit. And then hopefully your wage during that time, we've talked 10 years, hopefully your wage is also increased as well. And then obviously you've been able to knock down some other debts, let's say some personal debt, some car loans or something like that as well, and improve your position. So I think it's quite interesting to see where people been doing this for quite some time, where people start and then at that 10-year mark, the change that has happened, if that's just to do with a mindset and or they're actually more conscious of improving their position in that time, so that their opportunities are much greater in that 10 years to be able to do something than do the next one and off they go.
Yeah, absolutely. Look, the other thing, and I'll be cautious about how I say this, but there's a different type of tenant in the two different types of properties. So just stating facts that your lower value property is probably in a lower socioeconomic area, and perhaps it might be a tenant that may not be the most aspirational tenant, but everyone's got an ability to they've got to live the way they need to live to manage their lifestyle and their affordability. But obviously that higher value property may potentially deliver a better caliber of tenants. So without being running the risk of discriminating. But look, as investors, you want to know that, let's face fact, you want to know that your property is being looked after. So there's a balancing act there. But essentially, what it ultimately comes down to is what is the best approach, and that depends on your individual circumstances. So it depends on your financial resources, your capital that you've got to invest, but also your borrowing capacity, as we've touched on. What is your risk profile? Tolerance?
Yeah, that's what I was going to say. What's your risk? How long do you have? Like all of those sort of things come into it.
That's right. So look, the reality is, if we're talking to the 20-somethings or the 30-somethings that are still establishing themselves, they've got obviously a longer runway to retirement or financial freedom. They've got the time to go in a little bit more at that lower level to establish themselves and, I guess, dip their toe in the water. Whereas if we're talking to the 50-somethings that are investing for the first time, and they might own their own home outright, or they're just looking for that extra top up to give them a comfortable retirement.
Yeah.
But to what you just touched on, the window of opportunity is a lot less.
Yeah.
Perhaps we need to be slightly more aggressive without being high risk and chase that higher growth because we've got a shorter period of time to achieve it.
Yeah.
Naturally, obviously, you would hope that over time, as you said, your income's gone up, so your servicing capacity. But look, I mean, I'd like you to touch on, as we know, the less owner-occupied debt. So ideally, the older type of investor who is on top of their mortgage potentially has got more capacity anyway.
Yeah, that's true. I mean, like with the lenders, they take a bit of an old school approach with it, which is a bit of a different view from what's claimable in real world, and then their sort of more basic sense. And what I'm talking about there is when you actually go to a lender and you request funds out to purchase an investment property and you get equity out, sometimes they won't actually tag that as being investment and tax deductible in their calcs, which can have a bit of an impact. So if you're able to, like you said, the applicant with a lot of equity, if you can then show maybe the property that you're purchasing, or it's let's say a favorable lender, which won't do it in that way, that actually will tag that debt as tax deductible, it does give you that boost in serviceability. It just depends on each lender. It's a strange one sort of thing. And you sort of get the inverse, the infrequent inverse, I suppose what I'm trying to say, where people have actually pulled out equity from their investment property to do something personally, and that the lender will still tag that as being investment tax deductible debt, whereas in reality it's not. So you get those sort of instances as well, sort of thing, but it actually, works the other way for you, on the calc. So yeah, it's a bit of a strange one. So I suppose coming back to your point is that it depends on the lender. Yes, people with a bit of equity can get a bit of a boost as long as it's been presented right to the lender and you pick the favourable lenders.
And no, people, we're not encouraging you to pull equity out of your investment property to go and buy a jet ski, are we?
No. Yeah.
The thing with this, what it comes back to, and I've said it before, it comes back to, well, what are your investment goals? Where are you at in your on your journey? What's your capacity? So these are all the things that should really determine which of these is the best approach. But one analogy that I always try and share with people is typically capital growth starts from the capital cities and works their way out. So the analogy that I like to use is, imagine going to a park and there's a pond in the park. You pick up a rock and throw the rock into the pond. Where the rock lands in the pond is the capital city. So think of the ripples as the growth prospects of that property. So the ripples are fast and they're strong where the rock enters the water. By the time the ripples get out to the edge of the pond, they're weaker and they take longer. So think of that simplistically as the geographical distance. So your more expensive type investment that we've talked about tonight is going to be where those ripples are strong. Typically, there's always exceptions to the rule. And the more average price or the cheaper type investment is going to be out towards the edge of the pond. So does your strategy overall allow you the time to wait for those ripples to get out because it's possibly from a capacity or a conservative approach? Or do you want to chase that stronger growth and be closer in, but there's a cost to doing that?
Yeah, and I was going to say, and as you said, if your capacity is like that, you can only afford the those outer suburb ones, and hopefully then you've got time, then that's the best option for your strategy at that time as well.
100%.
So,
yeah, 100%.
Yeah, we've all got our own
Absolutely.
Attributes that we have to work within, and just do our best.
Yeah, absolutely. So I think that covers that topic off really well, hopefully tonight, for everyone. Simon, is there any more you want to add in the property space whilst we're talking broadly?
The only thing I was going to just add is the divestment. When you actually get to the stage of wanting to sell these properties, when that hits your strategy, is that if you've got multiple, then you can do it at opportune times in the tax year. Versus one, you sell it and you've pinged for capital gains in that year. So like if you've got, 2 or 3, then you can sort of stagger them out, one in each year. Sometimes with our financial year being different to calendar, you could get it in, let's say that autumn, time frame, and then one in the spring season sort of thing, same year, but different tax years sort of thing. So.
Yeah, 100%. And, I guess further to that point, there's a bit more flexibility around liquidity with that, having multiple properties, because, if something in your world changes and you need to access some capital, you might only need to divest in one of your properties, not your whole portfolio, because it's in one property. So that's a really good point.
Yeah.
Outside of that, I think we're good.
Yeah, I didn't have any other points, sort of thing. So yeah, it's good, interesting.
All right. Well, I'll look forward to talking to you again on the next episode.
Sounds good.
Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode.